How long will this correction last?
Now, this is a question on everybody's mind, and the frank answer is we don't know. However, what I think we can provide are a few pointers that our readers and our viewers can monitor to understand the turning point. So the first turning point would be if earnings rebound. In our previous question, we mentioned that earnings were quite weak in financial year 2025. Combine those low earnings with high prices, and Indian equities looked a lot more expensive as compared to other opportunities for the FIIs. We think as the earnings start coming back strongly in financial year 2026, as you see on the chart, some of the headwinds around the earnings growth will vanish, and that will allow the equity markets to start performing well. MK is talking about having earnings which will grow in double digits in financial year 2026. The second factor we think which will help the markets recover is the government policies, both economic policies and monetary policies. Now, when we look at what happened in financial year 2025, they were impacted because there was the central government election, which prevented the government from having its normal capital expenditure, and many projects got slowed down. We also had a relatively higher interest rates which were prevailing in India, which made many projects unviable or not as lucrative. And then also last year in 2024, financial year 25, there were situations around high heat and flood waves which also impacted the productivity of the populace. Now, as we go into financial year 2026, many of these factors will reverse. Why? Because as the new central government elections are over and we have a stable government, we expect the government is going to be growth oriented, and they will continue to come up with new projects which will allow the growth of the Indian economy to once again flourish. We know recently RBI reduced the repo rate for the first time after 5 years. And so that means that RBI is also once again starting to focus on growth-oriented policies. We think that as the real interest rate in the economy comes down, more projects will become viable, and we will see many more projects start. The third pointer here is a lower personal tax rate. The budget announced that the tax rates across all slabs have moved lower, or the slabs have moved higher, effectively reducing the tax outgo for most individuals. And this will provide more money in the hands of the consumer, which should provide a demand push, allowing the economy to once again pick up. These are two things. And then the third thing which we will talk about is the base effect. When we were looking at financial year 25, we were looking at how the companies have grown in financial year 24, and therefore what is expected in financial year 25. Now, as we saw earlier, financial year 25 economic performance has been weak, both for the economy but also for the companies. As we go into financial year 26, we will expect that earnings will grow faster from a lower base. Why is that? Because every country has a certain earnings growth potential. India, we think, is somewhere between 6 to 8% real growth rate, and we add 2 to 4% inflation, let's call it 4% inflation, then in nominal terms, we are expected to grow between 10 to 12%. So if last year the growth rate was 5%, we think that the earnings growth in financial year 26 can be much better. That will be another driver for Indian economy as well as Indian equities to start doing well in financial year 26.